Have we finally reached a peak in index fundation? As I look at this whipsaw market with the Dow rebounding nearly 1,200 points from yesterday's sell-off, I wonder if the most popular investing idea of all time, stick your money in an index fund that mirrors the averages, then forget about it, may have reached its high watermark. Yeah, we've reached a point where more than half of all funds are now indexed. And when it comes to money management, something that popular is rarely right. Remember, the whole premise of investing in an index fund is that it's impossible to consistently beat the market by picking individual stocks, so you can't beat it. So therefore, you got to join it. Now, I don't think it's impossible to beat the market. Remember the thing I created, FANG? That kind of crushed the market. But picking winners does take some time and effort, of which I'm willing to put in. I want you to put in. That's why I've been a fan of index funds, because I know you may not have that time. I get the appeal. But man, oh man, when everybody's got that same darn strategy, that strategy really works. I'm starting to believe that index funds have gotten too crowded. And a down market like we had last week really validates stock picking, especially for those of us who had some cash on the sidelines to take advantage of the weakness, as I did with my charitable trust, which you can follow along by joining the ActionAlertsPlus.com club. I still think there's a place for indexing. I've got some retirement money in it. I got money in a cheap index fund that mirrors the S&P 500, and I do believe that should be the bedrock of your retirement account. However, aside from that, the massive movement towards sector ETFs, which you hear about all the time, it seems increasingly foolish. The overall S&P 500 index concept works because the S&P is, in fact, a very actively managed fund. Each year, they take out the winners, those that have gotten takeover bids and are sold at a premium to where they were trading, and they take out the losers, those that got too small, usually because of genuine business risk. But these sector ETFs, well, they're nothing more than fee generators, and they'll argue otherwise, but I'm tired of them. Take yesterday. I spent a considerable amount of time with Mike Wirth. He's the incredibly good CEO of Chevron. Mike beats the competition on cash flow, growth, dividend, buybacks, even sustainability, considering things like flaring. But it doesn't matter. See, Chevron's in the oil ETF. And these days, the preponderance of oil stock trading is in ETFs. If I were still at my hedge fund, you know what I do? I go long Chevron here and short the darn oil ETF. That's an active manager's method. I'd use the ETF against itself, betting that Chevron will outperform the rest of the industry. We see the same thing in pharma. The drug ETFs have homogenized the unhomogenizable. We have some very good drug companies and some very bad ones. Same with biotech. They're too numerous to mention. But I highlight the winners constantly. Why would you want to buy the ETF that also sticks you with the losers? The ones that don't spend enough on R&D, so they don't have much of a pipeline, which is the key determinant of growth. Then there's the issue of the obvious, the bogus single stock risk that you hear about in ads. Single stock risk. The single stock risk of owning FANG, a watch, my acronyms for Facebook, Amazon, Apple, Netflix, and Alphabet, now Google, which was Google, or Walmart, Amazon, Target, Costco, and Home Depot. Is that so hard? Is that a single stock risk? These are the best companies in their industries. We know that. They have the best balance sheets. They have the best growth. They have the most unassailable positions. They got big moats. But the fee-hungry brokerage industry, which is constantly running out of ways to grow, would have you believe that each of these is more dangerous than the last because they're individual stocks. Scary. But if you mix them up, maybe you mix them up with Twitter or Snap or Hewlett-Packard Enterprise or IBM or Intel or Kohl's, Big Lots, Nordstrom. Hey, somehow you'll soften the blow. Bring in some mediocrity. That's not softening the blow. It's leaning into the blow. Why own both the winners and losers in an industry when you can just pick the very obvious winners? And every one of those that I said is mediocre, I hope they get better, okay? So those are saying, Jim, we're not mediocre. I hope you get better. I'm just looking at stock prices. Look, at the end of the day, these sector-based index funds were designed for a market where most investors picked individual stocks. We're now in an environment where, for many industries, many more people trade the indices than individual stocks. He's created indices. Ledger to man. Creates a lot of opportunities for those of you who are willing to manage your own money. Yeah, I know I'm early. But anyone who doesn't see this index fund peak on the horizon is fooling themselves. And enough with the single stock risk rating of our viewers who were smart enough to buy the good stocks and leave the raggedy rest to others. Brian in Ohio, please. Brian.
Booyah, Jim. Brian from Dayton Flyer Country.
All right, man. Speak to me.
Over the past few days, you've been mentioning a few high dividend-paying stocks you like and some you don't like. With Kraft Heinz now paying over 6.2% after the huge drop in the stock price a year ago, which of your list is that one on?
Well, that's a poorly managed company with pantry brands that actually may do better if you want to have a fallout shelter because we might have nuclear war with the Soviets since 1968 or 1958 and Khrushchev. Otherwise, why? I like good tasting food that's fresh. Something I learned when I was growing up. The mass movement towards sector ETFs is not prudent. It's not right for you. The index fund peak is on the horizon. Hey, much more Mad Money, including my exclusive with Dollar Tree. How are the coronavirus and Chinese tariffs impacting this company? I've got the CEO. Then stocks might be bouncing today, but there's still some serious discounts to be found. How about Cramer fave's Zendesk? Hey, why don't you get Zen like me, Jimmy Chill? Is it worth considering here? And all your calls rapid fire tonight's edition of the Lightning Round. So stay with Cramer. We are trying to make sense of things for you here tonight in the face of this incredibly difficult but panicky tape. I like to buy hysteria, not sell it. I like to buy panic, not sell it. We don't advocate panic because it's not a strategy. There are two kinds of companies in the blast zone. The ones that are at risk and the ones that are really at risk. What bounces best? That's what you must be thinking about at this point. What a day. We have your back and we'll get through this together.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.